from investment banking and from accounting. Uh, 3 degrees, amazing MBA, and I think that was from Kellogg, if I remember correctly, in Chicago, and then Boston BU for communications, and I'm forgetting the other one right off international relations.
I was
So,
at Boston. I was at BU.
oh, okay, alumnus. There you go. Watch out, Henry. Arturo will ask you for a contribution. No. Without further introduction, Arturo, you may want to fill in some of the pieces that I missed, but takeaway, so glad to have you join us today and appreciate your time very much.
Oh, well, thank you. Thank you, guys. It's an honor, obviously, presenting to you guys here at the M&A Forum. I'll start sharing my screen here. Let's see. So what we'll talk about today is I just launched a third book, which really is a second revised version of my first book, which is this new book is called Buy Yourself into Entrepreneurship. And what I do is I've started, bought and sold over last count 56 businesses across 18 different industries. And after over 25 plus years, and after a while, the industries kind of merge, they blur, and it's really all about the 3 Ps: people, processes, and product. I know we've all heard about those, but if you're able to do the process and have the right people, your product, if you're buying an established business, the product and service is already accepted by the market, so you have that to your advantage. It's really just making sure you have the right process and the right people in place. And I talk about how I do what I do and how I've done what I've done in this book. And I have started a couple of businesses. I think 13 businesses the last count. I'm not sure if you can see me, but that's tequila back there. It's empty, but that was my first business that I ever started. It was a tequila business, 22 years of age in Mexico. And I jumped ship from Bank of America. My partner also jumped ship from Procter and Gamble. We had these, great corporate jobs ahead of us, and we decided to be entrepreneurs. Probably the worst time to be an entrepreneur, by the way. It's when you have no context. It's when you have obviously no experience, but you think you know it all. You do have the energy, which is absolutely necessary. And we thought we can make it in the entrepreneurial world. Well, that was an amazing experience from a business standpoint. It was a terrible failure. We went bankrupt because we went against Jose Cuervo, and they just absolutely crushed us. And obviously it's great feedback. I really don't talk much about failure. I talk about feedback. But it's one of 13 businesses that I started where it didn't go so well. But all the resources, the financial capital, the time, the emotion of starting a business doesn't equate to a good ROI. And over the years, I began to see, why am I starting these businesses from scratch when I can maybe go out and buy businesses and totally bypass the startup risk, totally mitigate the startup risk. And that's what I started doing. And I started buying restaurants and then landscaping companies and then theater production companies. I bought an oil and gas company, and everything seemed to make sense in terms of risk reward. And that's what I've been doing ever since, just buying good established businesses. And I kind of liken to it. I use the example of Subway, because if you're going to start a business, the most conservative way to start a business as an entrepreneur, if you've never done this before, is probably get a franchise, have a brand that people already know, and have a proven system that's already been tested time and time again in so many different scenarios, so many different geographical areas, where you mitigate, obviously, a lot of the risks in starting a business. But even
Yes, ma'am. This is George Kurisky speaking.
How do you spell your last name?
Kurisky,
And date of birth?
8563
And cell phone number you provided?
713-805-7831.
Hey, George, we don't need your credit card information at the M&A forum. You might want to mute.
there we go. So so getting back to the Subway example, you know, people go into business and they buy a franchise, and Subway is probably one of the best known brands out there that franchises. And so if you were to buy a Subway, and these are their numbers, it's going to cost you roughly about $250,000 all in, you know, working capital, build out costs, training and whatnot. And their revenue ranges between $400,000 to $550,000 on average a year per Subway, and their net margins are around the 10% mark. So it's obvious that one Subway is going to do differently than a second Subway for all the different multiple variables that go into starting a business, right? It could be location, it could be bad training, good training, it could be great employees, not great employees, and you know, many other variables. But assuming that two different people started a Subway and spend the same amount of money, $250,000 again, which is the average all-in investment that a Subway franchisee you know, puts into their Subway, and assuming they trained their employees perfectly well and they opened on time and every single assumption they hit, well, I can assure you that one Subway is going to do a little better than the other Subway, or said another way, one Subway is going to do worse than the other Subway. And if we just go by their numbers, if one does $500,000 in sales and the other one does $400,000 in sales, and you have a 10% margin, well, one is making $50,000 a year and the other one's making $40,000 a year, right? And that's just a reality. So cost them both $250,000. One is making more and the other one's making less. I just wait and let them do all that. And once those Subways are up and running and the employees are trained and the market has found that Subway and is going there consistently and on a stable basis, and their finances are great, and they're making $500,000 or $400,000 consistently and those margins consistently, then I just jump in and buy them probably for less than what they purchased, what they put in into those Subways. So I buy between 2 to 3 times multiple of small business. So if they're doing, one is doing 50,000, the other one's doing 40,000, I can almost get both Subways for the price of one build out. And that's what I've been doing. And that's why I now shun away from starting businesses, because I get to mitigate all that startup risk. And a good chunk of that startup risk is out of your control, independent of how much you put, how much time, money, resources you put into the assumptions and the business plans and whatnot. So I follow I've been following this blueprint. I have a coaching program where I teach people how to buy businesses without necessarily risking their own capital and without prior experience. And they follow this same blueprint. And it's obviously, it's going to be very obvious to many of you. But there's a rhyme and a reason to the order. You know, one is deal specification. Why are you buying what you're buying, right? Today, my number one filter is price to earnings. I don't care if I buy a bar. I don't care if I buy a pest control company. I don't care if I buy a fabrication facility. I'm ultimately buying cash flow. So to me, my number one filter is, you know, price to cash flow to price. And so if I get deals that are just, the price is just way too high, where you're talking 4, 5, 6 times multiples, I just pass. There's just too many businesses. Deal sourcing, we're going to talk about this during this presentation, but you know, 80% of the deals that we source are not through intermediaries. And there's very, very efficient and effective direct and indirect methods of how you get in front of a business owner without having to go through necessarily an intermediary. And the other 20% is going through a business broker, an investment bank, or a boutique M&A house. Meeting the seller, we're going to talk about this in the presentation. Deal valuation is, basically pricing it out. We're going to talk about deal structure. So this is where we can come up with financing, and in certain situations come up with 100% financing. And we'll see an example of that. And then the rest is raising that capital, due diligence, negotiations, and closing. So I'm not going to get too involved in this. This is just so you guys know what I do and have been doing for many, many, many years and continue to do today. I'm evaluating 3 deals right now that are in some of these steps right now, some in the more in the latter stages here. So we're going to talk today about really this part right here about the psychology of the seller and meeting the seller, because I think 80 to 90% of any M&A deal has to do more with the art than the science. It's got to do more with the psychology than it does with the, with the objectivity. And we'll see why. And then the deal structure, the financial aspect. And those are the 2 secrets that we're going to talk about today as it pertains to what I do. So secret number 1 is really the psychology of the seller. I call this the 90-10 rule, just because the 80-20 rule has already been taken up, right? As I mentioned before, 80%, roughly 80% of the deals that we look at don't come from intermediaries. They come from direct and indirect presentations and introductions to the business owners themselves. And there's a reason for that. So if we look at the small business space, and this doesn't change much year over year. This slide may be 3 or 4 years old, but it doesn't change much. We all know that the economy, the big motor of the economy is small business. And, right at any one time, there's 28, 29, 30, 27 million small businesses in the United States. And these are other businesses in other parts of the world, because we do have international students in the coaching program. But this is just a ginormous amount of small businesses that are out there. Now, a majority of these small businesses are small one-person entrepreneurs, which is fine. Solopreneurs, a lot of people call them, because I've bought a lot of these solopreneurs as bolt-on acquisitions to a bigger acquisition, and then have synergies and have additional, or I'm able to scale what was once a solopreneur into a bigger small business. So this is just to give you guys context. Businesses are all around us, and we know this, right? And so let's look at the demographics. And the demographics for the next, probably 15 to 20 years are going to tilt in the direction that we're going to see here. So the 55% of those 28.8 million small businesses are the owners are people that are 65 years and older. If you add on and the ones that are 50 years and older, so they're the ones that are in the latter part of their lives, you're talking about a population of business owners that are in a certain psychological mode and emotional mode, which I call retirement mode or exit mode mentality. 85% of these small business owners are past, are in, or will soon reach exit mode mentality. So what is this exit mode mentality? Well, obviously when you reach a certain age or you reach a certain time in your life, you're looking for the next chapter in your life for various reasons we're going to talk about in depth in a second here. What that means that whether they've actively or not put their business up for sale is irrelevant. Psychologically, whether consciously or subconsciously, they're already thinking about the next part of their life. And that's a very powerful thing, because we can use that as buyers to our advantage and not to their disadvantage. And that's key, because I always look for win-win scenarios. It's key because you're able to reach win-win scenarios, amicable scenarios, because you allow them to go into that latter part of their lives, exit the business, and you enter the business, which ultimately you both want, right? Again, it may be consciously or subconsciously. So let's talk about this. Why are these, 85%, past, in, or about to reach in the next 5-10 years or even sooner, this mentality, this exit mode mentality? There's some obvious ones. Many of them are burned out. Many of them are frustrated and they're tired. I've bought numerous businesses where the owners are looking just to close the doors because they just don't want to deal with the business because, again, they're in a different phase in their life. Health issues. As you grow older, of course, health issues become more prevalent. Death is omnipresent, whether it's you, whether it's your immediate family, whether it's your extended network of friends. But it's a real issue, and it's a real issue that affects the day-to-day of these business owners, and it's ultimately directly and indirectly affects their businesses and their ability to perform in those businesses. So some of them are running out of ideas. They've been at this for 30-35 years. They've seen everything, but they're getting behind the 8 ball. They're getting a lot of younger employees who come in with new ideas. We'll talk about technology in a second because technology in and of itself is a new idea. But they get newer employees who want to do things differently, whether it's on the sales side, the advertising, whether it's the operations, whether it's the supplier side, whether it's technology, and they don't see it, they don't get it. And it's a cause of frustration. And in many of these small businesses, you will notice there's a lot of the employee base tends to be, not in all cases, of course, but tends to be older than younger. And that's because there's a clash of ideas. And it's just a natural, it happens in the professional and the business life. It happens in your personal lives. It's just the way it is, but that is a reason why they're consciously or subconsciously looking to exit the business. Technology. A lot of these business owners have never heard of or don't use the social media platforms for whom many other younger small businesses is the key to the success of their own small businesses. So imagine someone that's never opened up an Instagram account, or never opened up never looked at TikTok or a YouTube video. Imagine trying to teach those business owners to advertise, to scale, to acquire new clients vis-a-vis these platforms that they don't even use them for their personal life, let alone how are they going to see the potential? And that's just, that's the obvious one. So, there's softwares out there that I've got a manager right now in one of my businesses that is just anti-technology, and he's a younger person and he struggles. And I know this person, if it wasn't for technology, he could be a great entrepreneur, but technology is holding him back. And he's 42 years old and he hasn't gone over the hump of technology. So it hinders these business owners. Some of them have no real succession plan. And this is a very real problem for these business owners. They don't know what to do with the business. They either don't have children, or their children want to work for Wall Street or have started their own business. They don't want to go into dad's plumbing business or mom's bakery or whatever that business is, and they've moved on. So they have no one to succeed them. And again, their thought process is, maybe I just close the door. To many of us buyers, closing the door is what are you thinking? You're closing the door on cash flow. You're closing the door on a brand. You're closing the door on a business that's established. But to them, it's just I want to go into the next chapter of my life. Some of them can't afford the associated costs. So some of them might have personal loans. Some of them may owe taxes. Some of them may have personal guarantees on leases. And so they do want to exit, but they have these obligations that prevent them from exiting, and they haven't found a way around that. Probably one of the biggest one is loyalty to employees, clients, and suppliers. Their name on the door means a lot. And the employees that have been with them for years and the clients and the suppliers, their community is extremely important to this demographics. And so they want to pass that on to someone that's going to take care of that, take care of the employees, take care of the clients, be a presence in the community. And they haven't found it, or they're not looking for it because they think that they're the only person that can do that. And then there's the real fear of competition. So a lot of people that want to sell might not hire a business broker because they think, rightly so or not, they think that new buyers are going to come and steal their decision, their trade secrets. And so they tend not to open the doors. They tend not to open the books. Again, holding themselves back. But for all these reasons, these demographic, they want to sell. They're already in this retirement mode. Here's the thing. There's many surveys out there. I could send you this survey. This does not add up to 100%. But what this slide is showing is that 80% of them don't necessarily want nor need cash up front. So I kill the fallacy that every single business transaction is 100% cash. That's simply not true. In fact, we know just from statistics that about 50% of all small business transactions have owner financing, an element of owner financing attached to it. So just from that alone, we know that there isn't a 100% cash deal. But when you look at and you talk to this demographic, you begin to see that 45% of them in these surveys say that their legacy is the most important thing. They've got cash, they've got richness, they're willing to do owner financing or an earn out of something more creative where you don't necessarily need to come up with 100% cash, a cashier's check to the table. 18% say they want to safeguard their employees. 50% want some cash at closing, not 100% cash at closing. 10% want relief and retirement, and 6% eventually want cash. Now the other, if you add these up, the other percentages, they do want 100% cash. But so this is interesting because psychologically their motivator is in cash. Whereas for a lot of buyers, we believe it is. And we believe we need to come up with a lot of cash at closing, whether it's in the form of loans that we take, whether it's in the form of investors that we bring on, or whether it's in the form of us using our checking or savings account. And that's just simply not true. And so if we're able to understand this psychology, then we should be able to use it to our advantage and to their advantage. Because remember, we're both looking for the same objective. They're looking to exit, we're looking to enter. So if we play upon the psychology, which is what I do, we are able to reach win-win scenarios. We are able to reach good deals where we're not underbidding them. I'm not looking for distressed assets. Other business buyer may be looking for distressed businesses. I've done that, and it's kind of like starting a business. It's not worth the time and effort. The ROI, the risk reward is not there. So you tend to buy cheap, but it's very, very hard to bring it back to the profitability you deserve on a risk reward scenario. So again, 80% don't necessarily want cash. We know 50% seller financing is typical. We're able to protect the legacy up until a certain point. Of course, if you need to make changes once you bought the business, well, then you're gonna have to make those changes. And you can use this to do a financial structure without putting any capital down. So Mike asked me, how do I do that? How do I go and how do I talk to somebody as a complete stranger and end up as the trusted buyer? So we teach a process in our course, which is what I do every day. And again, it's got to do with everything we just talked about from a psychological level. Is we have a 3-meeting strategy. And I'm going to simplify it because we don't have time. We go in the course and in the coaching, we go into more depth. But basically, the first meeting is you planting the seed that you're interested in buying the business. So remember, 80% of the businesses that we're looking at are not for sale. They don't have a for sale sign out there. They're not with a business broker. And so you go and you eventually meet the owner. And again, that's sourcing, deal sourcing, how you do that. But once you do is you plant the seed, you say, I'm very interested in buying your business. Is this something you're willing to entertain? And that's it. You don't say much. You don't ask for information. You basically say, I'd love to meet with you at a different time. And maybe we can talk about this. And you allow time to play in your favor. So in this first meeting, all you did was plant the seed. And once you left, whatever they say, no, I'm not interested. Yes, I'm interested. It doesn't matter. They're going to go home and they're already starting to think, I could actually go into retirement. I could actually exit my business. You've already sparked that idea and turned it into a possibility. Whereas before it was maybe in the subconscious or in the conscious, but it was in the future. Now it's marinating in their heads. And now they're getting excited, whether they show it or not, whether they see it or not, because a lot of this happens at the subconscious level. And they'll go home and they'll tell their wives, they'll tell their friends. They may even share it with a trusted employee. And you allow time for that seed to marinate. And the more that marinates, the more because they're already in this exit mode strategy. So now they're getting excited about the possibility of selling because somebody knocked on the door and said, I'm interested in buying your business. And then you have a second meeting. And I usually say, please have this meeting not on your turf or their turf. Have it in a coffee shop, invite them to lunch, invite them to breakfast, but in a neutral place where you can talk and speak as people, not as buyer and seller, not as owner and prospective purchaser. And that's when you start asking questions about the business. And you let them talk and tell you everything about the business. And I'm not talking here about the net income, and I'm not talking about the gross margins. I'm talking about the challenges, their employees, the competition. Let them go back nostalgically through when they started the business and tell you about everything they've done to get to, from when they started it to point A, B, C to the point of today. In other words, let them talk. And you just be a sponge and you're learning and you're understanding what's driving them just based on what they're telling you. And the more they're doing this, the more they're opening up to you, the more they're seeing you as a buyer. Before you were a stranger, now you're becoming a buyer. And the more you ask these questions and you feed into what matters to them, the more you become a trusted buyer. Try it, guys. It's a beauty when this happens, because after that meeting, and we go into the third meeting, if that meeting goes well, you become friends. You've talked as two strangers about their business. You've gathered an immense amount of knowledge, information about that business to see whether you want to go forward or not. And you could, if not, you can stop right then and there, meaning you don't go forward with the deal. But should it still interest you, now you're evolving naturally, psychologically, from a stranger into the trusted buyer. And then you have that third meeting. That third meeting, you normally have it at their office, in their place of work, if they allow it to. And that's when you talk about the facts, the hard information about the business, where you physically look at the business if there's a physical location, where you talk about maybe income statements, but now they're giving you this information. And now you have become the trusted buyer. And this works like magic. Doesn't always work, but it does work. And it works great. And that's how you go from a complete stranger to a trusted buyer. And I've done this, guys. I've bought restaurants this way. We bought a fabrication facility, which we still own in Trinity. We bought a bakery here in the Woodlands, a French bakery bistro, by just doing this. They didn't know who I was, humble person, walking in there. I don't tell them about what I've done. I just want them to trust me. And then once I gain their trust and I become the buyer in their minds, then I prove to them that I can buy the business. But now they're on our side and they're going to help in an amicable structure that's a win-win structure. So this is all mentality. This is all psychology. This is the art of the deal, which again, I believe is the biggest aspect of any M&A transaction at the small business level. So what do we do with the other 10 to 20%? Well, we do use intermediaries. We do use business brokers. But remember, most of the time, the business broker may have giving the wrong expectations to buyers, to sellers. 100% cash up front, we're going to get the highest price. Well, we all know the market determines the price, and it's very easy to value a company. It's not harder than valuing a piece of property. The information is out there, the comps are out there. The multiples don't lie. And so it's very easy to value a company. And what we do know is that in the business broker industry, we know a lot of the listings never sell. And they mostly don't sell because of artificial expectations. And so as time goes by, some of these listings, mind you, these are good businesses. These are good, there's nothing wrong with the business. It's not selling maybe because the price is too high. Maybe because they're not, the seller is not interested in anything but a cash deal at the beginning, or some other factors. But eventually, over time, these become aged listings. And just as we talked about before with the psychology, they're already, the second they listed their business with the business broker, exit mode already, went into effect. And so they're looking to sell their business. And some business owners stop investing, stop operating their business as they did before. And after some time, that begins to show. And so they come to a fork in the road and they say, either I start diving right back into the business, stop the selling process, or I lower my expectations and start being more flexible on price and structure. And that's what we like. We like motivated sellers, not distressed businesses. It's a very different thing to have a good business, but a motivated seller, for whatever reason, in this case, is because they've been, their listing has been sitting and it hasn't sold. But we like motivated sellers only because they're going to be like the other demographic, where they're going to be now amicable to creativity in terms of price and structure. Right? So that's the first secret, which is more the psychology. Secret number 2 is the financial structure. Right? So how do we go about the process of financing business purchases? And how do we go about the process of buying businesses, sometimes without putting any of our own capital on the line? Well, traditionally, what people do is they use their personal assets. So they will bring money out and they will pay cash. I've done it. Absolutely nothing wrong with it. They'll go to friends and family and raise money in the form of debt, equity. They'll go to their immediate network, their friends, or their extended network, or they'll look for professional angel investors. And again, I do this. It's the common way of raising money to buy a business if you don't want to put money down, or if you have the money, then obviously you use your own money. There's more creative ways of doing this, though. Just like you would buy a house where you don't own the house, yet you go out and get a bank to give you a loan and take the house that you have yet to own as collateral vis-a-vis a mortgage, and you purchase the house, which becomes now yours vis-a-vis a mortgage. There's asset-based lending. And I think this is the most underutilized financing available out there. You can buy businesses using equipment financing. You can buy businesses using receivable financing, inventory financing, real estate financing, even merchant cash advances, which I'm highly against, although people use that as a bridge to a longer term type of funding. And so some businesses have assets, and you can have specific asset-based financing, equipment, receivables, inventory. Well, equipment and receivables, equipment and machinery usually do about 50% loan to value. Inventory about 40 to 50% loan to value. Receivables up to 80%, depending on the receivables. Real estate up to 90%. Right, so these are variables you can use depending on the type of assets that the business you're looking at has. And again, a lot of people fail to use this, and it's a creative way of doing this. There's thousands of asset-based lenders that, you know, when you go out and buy an asset as a business owner, they'll finance it for you. Well, they'll do the same for a business purchase. A lot of people don't equate asset-based lending to business purchase, but it happens every single day. That's one way. Another way is you take on a lot of the existing debt. So right now in today's arena, there's a lot of these PPP, SBA loans. A lot of them are assignable. Now, the typical SBA loan normally isn't assignable. I mean, it's assignable if you get the approval from the lender. But right now, today, I'm seeing more and more existing loans being assigned, and even SBA loans, which I hadn't seen before. And it's got a lot to do, I believe, with EIDL and PPP. But even if it wasn't an SBA loan, if they have existing debt, you want to go to that existing lender that already knows the business, that already knows the income statements, that already knows the cash flow, that already knows the employees, and you want to assume that debt. And that's a way to purchase a business if they have existing debt on the books, right? It's not always the case, but again, it's a variable to play with where it is available. And then of course, there's owner financing. In owner financing, there's various hybrids from your typical, 5, 7, 3-year note at 6%, 8%, whatever that rate is, to a combination of earnouts and more creative ways of doing a seller note, even with equity, which is more like a preferred note type of a scenario. And then there's one that I've come across, and a lot of my students have come across, to use to purchase a business, which is what I call el comodín. That's how you say it in Spanish, which is kind of like the wild card. You're able to get a lot of business funding, mostly through business credit cards, upwards to $250,000. And there's companies out there that specialize in getting you business credit cards that within the first 7 to 10 days, upwards to $100,000 at 0% interest rate. I have a whole course that teaches you how to just do this, not necessarily to buy businesses, but for working capital, for business purchases, for real estate flips, for equipment purchases, for marketing budgets. Day traders use it to do their $25,000 balance that they need so they could do day trading. I mean, you could use it at your discretion, but we can also use it as a bridge or as kind of like your wild financing card. If you're trying to do a 100% money down deal, this could be the one that actually closes the gap. And the great thing about these is that they are 0% interest rate. The terms are usually 12 to 24 months. It doesn't appear on your personal credit. You do use your credit, your personal credit, to obtain it. So if you have a 500 credit score, then this is not for you. But if you have a 650 to 680 credit score and above, then you can get 50, 60, 70,000, upwards to 100,000 of business credit where it doesn't appear on your personal credit. See, most loans use the 3 C's: cash, collateral, and credit. Cash is cash flow. So they want to see your revenue. They want income verification, right? Collateral speaks for itself. And this is the C, the credit, where they're going off of your personal credit, but it doesn't appear on your personal credit, which is beautiful because you get money and it doesn't hurt your credit, which allows you to get additional money in the future. And again, there's a whole way of doing this, but there's no collateral required. There's no tax returns required. No partners or investors needed. No income verification. So this is a very interesting way to buy a business or to use the proceeds of to close the gap. And here's an example. Hopefully you could see it with all these numbers. This is the plant that I was telling you about that I think I alluded to, the fabrication facility that we own up in Trinity. We bought this company about almost 4 years ago, a little less than 4 years ago. And this is a snapshot. There's a lot more to this. It had SDE. I'm assuming everyone knows what SDE is, seller's discretionary earnings. It's very different than EBITDA. Mike and I talked about that before. But it basically encompasses everything that it's the cash flow, the net cash flow to the owner after paying all expenses and obligations, right? So this had an SDE of 414,000. We bought it, I believe, at a higher multiple, but we were willing to pay a higher multiple because of the structure that we were able to get, because we had a win-win scenario with the business owner. We assumed about just shy of $700,000 of debt that the business already had. We added working capital and fees. So a lot of the deals that we do, we have lawyers and accountants on contingency, where based on relationships formed across many years, they're willing to take that risk, and we pay them well should the deal go through. But it's in contingency, so that's part of it right there. And so it was a 1.6, 1.7, call it purchase price, again, 4 times. With the existing debt and then adding working capital and the fees, we had to come up with about $1.1 million in additional funding. And so we went about this by using accounts receivable. We got 75% inventory. This is a factory, so they have a lot of steel. They have a lot of valuable raw material. So if you bought a service industry, this may not work because usually there's very little, if any, inventory. There's a lot of equipment here where we got about 40%. And then here's the business credit funding or credit cards. We used about 190,000. And this is where I say it's a wild card. It's the comodín, right? Because we could have gotten more, but we didn't need to. With this, we came up with the needed funding because we did have also owner financing. And that closed the gap, and this was a no money down deal that we did. And then you obviously want to, now you assume new debt. So you obviously want to make sure that this SDE is able to service the new debt. And here's just some weighted average, because I didn't do it per financing, but it comes out to roughly about $200,000 in additional debt that we had to finance. Does the SDE cover it? Yes, it does. And it leaves us with a good still net cash flow without putting up any of our own money. So this is an example, a real life example of how we were able to buy a business using all the creative things that we talked about, and also using the psychology. This was an older gentleman that had a family as partners that wanted nothing to do with the business, which gave us an advantage. So in a nutshell, those are the 2 secrets that I use out of the whole business buying blueprint. Happy to take any questions here. Mike, I believe that's the next step here, right? I'll stop sharing my screen unless you guys want to go back to any particular slide.
Arturo, I've got a question and kind of an observation, I guess. I've been interested in the Houston region's progress towards encouraging entrepreneurship, and especially through Houston Exponential. But sometime last year, I don't remember exactly when, I went over and spoke to Rice's graduate entrepreneurial class. And I got up and the first thing I said was, why do you want to own a business? And there was complete silence, which indicates to me that most of these people who think they want to be entrepreneurs don't have a clue what that really means. What's your observation?
Oh, I agree. I mean, I'm an example of that. I wanted to be an entrepreneur for all the wrong reasons, literally for all the wrong reasons. A tequila. My next business venture was a club, and I wanted to buy the club. I was in Mexico at the time because I wanted the VIP table. So I put all my money up to have the VIP table. Now, luckily I wasn't that dumb, and there was a lot of luck that surrounded me, and we did very well in these clubs before they opened. I brought in partners, cashed out, got lucky, but my mentality was off, right? And a lot of people want to make money. That's probably the number one driver at an early age, right? A lot of people want to go into entrepreneurship at a later age for other reasons. They want to leave the corporate world. They want to control their future. They want to create real wealth, or other reasons, right? But the new entrepreneurs, the younger entrepreneurs, tend not to have a real idea as to why they're going into entrepreneurship. I fully agree with that, and I'm a walking example of that. And the worst part about it is you're gambling your own money. I gambled my money and I lost money. I didn't really take that into account, as ironic as that may sound. The drive to be an entrepreneur the itch was so prevalent, that I didn't realize that I didn't have any context. I didn't have any perspective. Certainly I didn't have experience. So when I would be in a client, supplier situation, how am I going to deal with that client if I've never dealt with a client? How am I going to know if pricing is right or wrong if I've never dealt with pricing or terms, or even not negotiating with a supplier? I could read all the theory I want, and usually you don't at an early age, but you don't have perspective and you don't have context. So it's the worst time to be an entrepreneur, in my opinion. Go out in the real world, get some experience. Forget about the age, get experience. So I wanted to be an entrepreneur when I was 22. I left Bank of America, and I had a beautiful career in front of me. And I left that, and I could have, it could have been a big mistake. Luckily, it wasn't. But I certainly didn't mitigate or didn't understand that the ginormous risk that I took. Maybe 3 years later, when I was 25, there isn't a big difference between being 25 and 22. I would have had at least context, at least some perspective, at least have dealt with clients and employees and processes and suppliers, and actual real products and services, where I have now context, perspective, and some experience, where maybe entrepreneurship may seem to make a little bit more sense, right?
I got a question.
Yes, JB.
Thank you, Arturo. This is really good. You got an awesome career there, and this is what I scribbled down when you were talking about restaurants and I think a fabrication facility, etc. So, do you have any generalized indicators that you like to rely on to determine market acceptance of a particular business's product?
I don't. I don't, JB, and this is why. When, my whole philosophy is you're buying an established business, which ultimately means you're buying cash flow, right? So whatever the product is, whatever the service is already implicit in that cash flow. It's already been accepted by the market. So whether I like it or I don't like it, or whether I believe there's a future or there isn't a future, is really irrelevant as it pertains to the purchase, right? What I do after the purchase is now I'm not acquiring, now I'm operating a business. And then I do care, especially if I'm going to launch a new service or a new product, or change the existing service or product, then I do care, right? But as it relates to business acquisitions, not at all. In fact, my best purchase, financially speaking, was a bar in Crosby, Texas. I'm not sure if any of you know where Crosby, Texas is. I sure didn't.
Yeah, it's full of beautiful girls. I know the place.
You know the place, right? It's in the middle of nowhere, this bar. And had I said, do I like the product or service? I would have said, no, I don't want to be in the bar business. The hours are long, it's night, you deal with different people, right? Getting back to your deal criteria and step number 1 in that 8-step process. But because I've done this so many times, I was looking at price to earnings. And I said, this is a business that has a good price given the earnings. And they've been given, had great earnings, steady earnings for 9 years and steady revenue for 9 years. This looks like a good business. And so I went and I did the next step, and I realized that it's ran very well and somewhat absentee. Long story short, we bought the bar, we bought the real estate. We made our money back on the business purchase in less than a year by doing minor tweaks. We still own the property. We sold the bar March of last year, literally as COVID was starting. We bought this back in 2009. So I owned it for almost 12 years, 13 years. We still own the real estate. Had I, I know it wasn't your question, JB, but had I had something against the product or service, I would have talked myself out of the best deal I've done, financially speaking. So I'm very open-minded as to products and services. I've been in oil and gas, Henry. We bought a secondary, tertiary company that was actually based here in the Woodlands. I knew absolutely nothing about oil and gas, and I still don't. But we did well. Why? Because I'm buying an existing established business that has the infrastructure. And by infrastructure, I mean the employee base, the experts, right? That know oil and gas, that know whatever that niche is. And if you're able to keep them, or you want to keep them, or you want to bring others in, they're the people that need to know the technical side of it. You need to know how to manage the business. But had I said, I don't know oil and gas, so I'm not going to go into this industry, that was my first IPO, by the way. I would never have done that, never have been involved in that type of transaction.
I would like to take you back to the beginning, to the very beginning. So you used your own money at the beginning to acquire businesses?
The first business that I acquired, I used a combination. It was a restaurant here in the Woodlands, actually. It's a brand you guys have probably eaten at. It's well known in Houston. It's called Russo's New York Pizzeria. There's 50 of them or 60 of them. So we bought the one in the Woodlands. And I was very scared because I know nothing about the restaurant industry. And I can't make a sandwich for the life of me. So even worse, the mystery of how do they bring out plates when you have 120 clients all sitting down at the same time, scared the crap out of me until I realized it's a process, right? But to get to back to your question, Henry, my first one was a restaurant. It was a combination of using my own cash. I had a partner. He put up his cash, and we had owner financing.
So if if you did not have your own cash and you did not have a partner that's willing to put the cash, you would not have started this entrepreneurial business?
No, I would have, in this particular, so a restaurant, and that's a great question, Henry, because it leads me to this. I've bought, I think, 12 businesses or 13 businesses without putting my own money down. But not all
No,
businesses.
I'm speaking about the beginning. I want to go back to the beginning. I don't want to go back to what happened later. I'm speaking about the beginning. This is where I am now.
Correct. So had I not had money or had my partner, knowing what I know then, I would have probably been at a dead end. Meaning I didn't know about business credit card funding. I didn't know about equipment financing, asset-based. I knew about it, but I didn't know you could buy a business. I knew very little about SBA loans, very little. And that's something I didn't talk about in today's presentation. That's very prevalent in the small business. But it was my lack of knowledge. To answer your question, I probably would have just come to a dead end.
Okay, just I have two more questions if the audience don't mind. And the second question is, so now you are focusing on small businesses. But
Yes.
suppose that you find a large business and you like it very much, and you know that it has great potential, and he wants to retire, and everything, it has all the check marks, it's wonderful business, wonderful profit, the potential is great, blah, 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 but it's a large business. And your money, your partner money is peanuts to support acquiring that business. What do? You forget about it because now all the financing schemes you told us does not apply that. It's something bigger than that to apply. What do you do?
Sure, that's a great question. So usually when it's a larger business, and we have to define what large means, right?
Yeah, exactly. I mean, larger than what you have. This is your category, and now it's like you want to go to something really way bigger. But you know,
100 million.
Correct. So the oil and gas company that we brought in institutional money. So I didn't put up any of my own money for that company. We brought in institutional investors and we brought in a fund to buy that company.
How did you find that investor? The investor will tell you have not done it before, how you want me to give you the money. And it's your first time doing this business, you know nothing about it. So how does that?
Sure, I get that question every business I purchase because I bought businesses in 18 different industries that I knew nothing about. Like we mentioned, the restaurant industry. What they do realize is that the business, independent of me, the business is a good business to buy, right? And they know that I'm a good manager, that I have a track record. I have a track record as a corporate person and as an entrepreneur. And I'm able, they have been willing to bet on me. In fact, before I bought a business, we raised $10 million through venture capitals to start a logistics company that I knew nothing about, internet-based platform in Latin America. I'd never been to Brazil, and we had an office in Brazil. So how many doors did I have to knock on for venture capital? I lost count. Hundreds in New York City, in Silicon Valley, in Dallas, in Houston, in Mexico, in Argentina.
But what kept you going? What's the belief that you have? What's the faith that you have to kept you going, that you will find someone?
Well, I just believe that I can do it, and I've done it. You know, I've never doubted myself. You know, I guess the mentality thing. I've got confidence in my. So that's a question.
And Henry, it sounds like you need to take the class.
No,
Yeah.
it's not about doubting yourself, but it's not only about yourself, that it's you and there is the market. And if the market is telling you no, you might be the great guy and you have confidence in yourself, but the market is not going to appreciate that. What keeps you going?
Well, I don't know how to answer that other than I have confidence in myself, and the market has spoken and has lent me the money, and has invested equity in my businesses, in startups. So I'm able to pitch well. I'm able to prepare well. I'm able to understand the opportunity and sell it well. I'm able to align myself with a strong team, whether it's partners or a management team. We've got to look at deal by deal, but I've raised hundreds of millions of dollars in debt. And they all ask that question, why you, Arturo? And I'm able to convince them, and I'm able to make them money. So today, 20 years later, one of my recommendations when there is referrals is CVC Latin America, which is Citibank Venture Capital, from what we did back in 2000. So I did something right in their eyes that today, 20 years later, they still, give me a badge of approval. But I've been able to do it, Henry. I don't think there's a secret sauce. You've got to believe in yourself. I don't have the imposter syndrome that a lot of people do.
No, I've been doing it for 6 years here, so definitely there is belief in myself. Maybe we can talk further offline, but I have been doing
Yeah,
it.
we're running up against time. In respect of everybody's time here, we need to call a halt. Arturo, thanks. This was really fascinating. I really enjoyed it. I think everyone else did too.
Thank you.
Everybody
Mike.
online here. It's amazing.
Yeah. Mike, you want to jump in and close up?
Yeah, can you pull up my last slide, or the last slide there? Folks, I did not, this was put together yesterday morning. And this is a reprise. Just randomly, I reached out, just hit a click, I did a click on my presentations file and came up with this one. It was from 3 years ago when the folks from Parkland High School marched in Washington, D.C. It was called the March for Our Lives. If you remember, they had the 17 and the 18-year-old speakers there on the Lincoln Memorial. And of course, before the day was out, we had yet another situation with gun violence, another mass shooting in Colorado, in a place that I've got relatives and friends and so forth. Know Boulder very well. I don't know that I've ever been to that King Super, but I've been to Boulder quite a bit. It's tough, but again, it turns out it's ironically appropriate to remember what happened 3 years ago, what happened 30 hours ago. And as Ronald Reagan pointed out, it's not about fate falling on you no matter what you do, but it's if you do nothing, then fate will fall on you. So let's do something. Let's spend some time doing something. Arturo, that was really, really good. Like I said, I didn't even get to my questions here. I got 6 stars and everything else, but anyway, it was really good. Thanks. Austin ended up with a conflict. I'm sorry that he couldn't join us today, but I will thank him personally, and I'll thank you again. Anything else, Bob? I guess the next meeting is April, and we have Virtual Q. The CEO of Virtual Q is going to talk to us on the tech side of the world anyway. So that's coming up, and then we've got a couple more months before we get to be back, at least part of us in person. But we are going to keep it mixed and see how we can make that work for everybody. So
Okay, and I promise a online social by the end of next week.
thank you so much. All right, thanks everybody.
Thank you for this
Katie,
discussion.
Henry, everybody. Ciao.
Thank you.
Thanks, Arturo.
Thank you, Arturo, very much.
Thanks, Arturo.